And for a closer look at overseas opportunities, Nathan Bell from Peters McGregor joins us live now from Sydney. Nathan, good morning to you. We were just doing a bit of a recap there in terms of that US session, but in terms of European equities, we saw that weakness coming through. This, of course, off the back of investors digesting that comments from the European Central Bank. Now, to that end, you've actually been looking at European banks quite closely of late. To get your take in terms of how we're seeing comparisons in metrics, dividend yields, for instance.
Yeah, so we made a switch from the US banks to the European banks gradually over the past 6 months. Most people aren't particularly interested in buying Italian banks, for example. If you read the news headlines, it actually looks very bad with some banks going bankrupt. But if you actually look on the ground, this is part of the clean-up operation that really should have been done 4 years ago. So in a sense, buying the European banks today is quite like buying the US banks about 2 or 3 years ago. People aren't incorporating higher interest rates into the valuations. You can still pay around book value or less for businesses that are going to have return on equities of 10% or higher over the next couple of years. But the market's really not going to push those share prices right up until they start to see interest rates going up, which is exactly what we saw happening to companies like Bank of America last year, which basically doubled as soon as people started baking in those higher interest rates. I know Australians love their dividend yields, and the European banks actually generally have around 3 to 4% dividend yields. And I saw the powder keg in one of the previous stories for the Aussie housing market, and if we actually get a real proper housing downturn, you're going to see that Aussie dollar come right down. So the dividends I would expect would fall for the Aussie banks as earnings come down as well. So I think the European banks are probably the safest to invest in at least 12 or 13 years, and I think offer much better total returns than the Aussie banks.
Well, just with that in mind, in terms of coming from a client perspective, perhaps, of course, we know that the Australian financial sector makes up a significant part of the ASX 200 and indeed some of the holdings that we do see Aussie investors taking in terms of their own portfolios. How much appetite is there at the moment, to your mind, for Australian investors to be switching some of their Australian bank shares for European banks?
Look, to me, sitting there with the global view, I think the European banks offer so much more value than the Aussie banks. The Aussie banks are in a completely different part of the cycle to what the European banks are. I'd say it's probably the most riskiest time to buy Australian banks in probably 15 years or more, whereas the European banks, it's the complete opposite. It's the safest in 15 years. So I think Australian investors are very focused on those dividend yields, but if we have any trouble with the housing market, then they're going to fall along with the earnings, whereas the European banks are essentially at the bottom of their cycle, and interest rates are negative 0.4% in Europe. So if they just get back to even just a positive, it's going to have a huge impact on profit margins, and we're starting to see those earnings go up, and that will take dividends up as well.
Now, no one can say, Nathan, that you don't think outside of the box. And one item that I did want to get your take on, I understand that you've recently purchased, was in fact your first Indian stock. It's actually listed in Toronto, Canada. Now, what's the lowdown here?
So it's actually really difficult to buy stocks in India directly. For a retail investor, it's virtually impossible. It's actually even very hard for a fund manager to get a license. So we've recently been tracking India, and we've ended up buying what is essentially a listed investment company listed in Toronto. It's called Fairfax India. It's basically you're buying a ready-made portfolio of private businesses. There is a fee structure similar to an LIC. It's related to Fairfax Financial, which a lot of value investors might know is the Prem Watsa run. Fairfax Financial is like the Buffett or Berkshire Hathaway of Canada. And so we've invested in this fund, and we've actually paid around a 25% premium to the net asset value, and which is normally not what you do as a value investor. But we actually believe one of the assets in particular, a PVC company called Sanmar, is drastically undervalued on the books. And over the next few years, we'll see that gap come down. So it doesn't look like a value investment on face value, but we think the intrinsic value is much higher than today's reported value.
Just while we are talking Canada for a moment, I wanted to actually get your take on some of the house price action that we are seeing there. A slight switch to some more economic talk, but we've seen falling house prices in Canada, in fact. Now, conversations that we have with yourself and also with some of our other commentators do draw those parallels between the Canadian market and also the Australian market from an equity perspective, from obviously that commodities focus also. Can we start drawing parallels between the housing markets?
Yeah, I think there's a real lesson here, and A few months ago, there was probably around April, a company called Home Capital, which was a pretty aggressive lender in the Canadian market. For Australians not familiar with Canada, they have a very similar housing situation to Australia. They have the very same banking industry dominated by 4 big banks. And last year, Toronto house prices went up 30%, which even left to 20% increases on the east coast of Australia in the dust. The problem was Home Capital actually had a run on the bank. And in the end, actually, Warren Buffett, Berkshire Hathaway chipped in to save the business. But I think the lesson is it was only 6 months ago you'd have a house opening and 15 or 16 people would be there trying to get their bid in. And just in the 3 months in this Home Capital situation, now people are struggling to get 2 or 3 people to come and visit their home, and people are desperate to get agents to get people to come and see their house and sell it. So finally people are actually starting to question the value of these properties. But it turned on a dime, and I think that's the real lesson for Australian investors, is that when, it's a bit like the Emperor's No Doesn't Have Clothes story, as soon as people realise that, the market changed very quickly, and property isn't like a stock that you can buy or sell at the press of a button. They're actually illiquid assets, but you just haven't noticed that in Australia because there's always someone to buy your home. But as I said, if you've got a lot of debt and your price gap's down by 10 or 15%, as they have in some parts of Toronto, you can be left in a very dangerous position.
And just how much are you factoring into this rising Australian dollar into this story, and also, I guess, actually into many of the themes that we've discussed this morning, Nathan?
Yeah, I think this is a real opportunity for investors. I think 1 to 2% of all self-managed super funds have assets abroad. It's a tiny number. And as I said, that housing issue is a really big one for Australia. Nothing's really gone wrong yet. But the debt levels are just huge by historical standards, they're huge by international standards. At some point, even if the housing market doesn't roll over, we're still going to have slower growth as we have to deal with higher interest rates, or, you know, we've got 40% of all loans on the Australian banks are interest only. At some point, people are going to have to start paying the capital back on those loans. So again, it's just going to be more money coming out of the household, having to go back to house repayments. So I really think this increase in the Aussie dollar at the moment, which is near 80 cents US, I have no idea how high it's going to go, but I think it is a real opportunity for Australian investors to try and get some of that international exposure that they're currently lacking.
Currently seeing the $8 tracking just above that 79 level. This, of course, after we did see it sinking off the back of RBA comments on Friday. Nathan Bell, we are out of time. Great to have you with us this morning. Thank you.
Thanks, Natalie.
And locally, it is